where are we at in the market today? Both, let's use the S&P 500 as our proxy for the market at large, and then let's answer the question with regards to the Century Management portfolio.
Okay, if you use the S&P 500, I've seen ranges of $70 to $90 earnings. We use a normalized earning because while they could go to 90, that's not the normal range. It probably, after we do our three methodology, we come up with 67. That's a very conservative number, but we do that on purpose.
So 67 is our estimate of normalized earnings for the S&P.
That's correct. And the way we do that is we take the 10-year average and add inflation, and that's sort of what most people do. That's what the Schiller methodology does. But we add a few other things to double check it. And that is we take the normalized profit margin times the current sales. That's the second method. And then the third method is we take the book value and we figure the average return on book, and then we apply it to this year's statistics. And so we have three methodologies to come up with it. But when it's all said and done, $67 is a very conservative number. And even the lowest number on Wall Street is $70. The highest, I think, is 90, and we're using 67.
And what PE would you use to multiply that $67
okay,
earnings?
On a normalized earning, 15 to 16 times would be a zone of fair value. We are at 1072 today. So on normalized earnings, we're at about 16 times. And that, I feel, is fair value.
A PE of 16 is a fair value PE, and the low end of fair value would be a 14 PE?
Yes. Yeah.
Okay.
And so you have a range in fair value, but I would say that when we get stocks in this market at 14 times earnings for the S&P, not for every stock, then I would say that's the low zone. And if you want to use a worst case, like if something really worse happens than fundamentals, you could use 13.5. So where that puts us is we're at 1070 today. If we go to the low end of fair value, we're down about 12% to 938. And if we use a little lower value than that, the real extreme low in this market, I would say it's 13.5 times earnings, and that would be 905. So somewhere...
And that would be more of a buy zone.
Yes.
Right?
Oh, no. Anything below 938 is a buy zone. That would be the worst case kind of thing.
And it's not that we can't find other buys when we're in a fair value.
No,
it's just you would have a wider range of...
Yes. But I'm applying that to the S&P because
Right.
that's what you asked me about. So the range in the S&P, I would say, is 1070 on where we are today to as low as 905, which is 16% down from here. The more probable will probably be to the 14 on, which is about 938. So somewhere between 905 and 938 is where I would expect the market to present real great values.
And for the Century Management portfolio, more specifically, where do you see that?
Well, that's the good news, is that the Century Management portfolio is actually at the low end of the range now because we're at 14. The market is at about 16, and we are at 14.
PEs, right?
Yeah, the price-to-earnings ratio. So the Century Management portfolio, if we were to make an index and put it all together like we do, we're selling at 14 times earnings. The rest of the market is selling at 16. So we think it represents value.
And earlier we talked about our composite portfolio having a price-to-book ratio of 2.12 and a price-to-sales ratio of 0.75, which on those metrics, like the PE, are on the lower end of the
Yes.
ratios.
If you look at 0.75% of sales, that only happened twice. That was in 1990 with 10.75% interest, and it happened in 2009 at the bottom of the market in March of 2009. So our portfolio on a price to sales is at a significant discount to the market. So that is what we feel very good about, is that we've got a good portfolio of value based on any metric you want to use, but if you want to use the price to sales and price to book, it's at the lower end of valuation.
Sometimes we look at our portfolio and compare it to the value of bonds. And so if we take a look at the earnings yield right now, our portfolio, when we invert that PE of 14, it's actually 14.2. If we invert that, we come up with an earnings yield of just over 7%. And so how do you relate the value to that?
Okay. One of the things that history will bear us out, is that there is competition between stocks and bond, and rightfully so. If you can make as much in a bond as you can in stock, then why would you want to buy a stock? Because you have the volatility and the risk. The bonds certainly are much safer, in principle at least is secure. It doesn't protect you as well against inflation, but your principal is secure. So what we have found out is that when you take the earnings yield, like you did of the PE, 14 divided by 100, you come up with 7. We have a 7% yield in our earnings yield on our portfolio. The bond yield is about 6.23. That's the BAA, investment grade bond is at 6 point. So by buying stocks, even in today's market, even though it could go a little bit lower, it's a great value because anytime you can buy stocks as cheap as bonds and have the growth of stocks, then you are usually at a real good value point because it makes sense. If the bonds are at 6%, so if I could buy a stock at same yield as 6% and get the normal growth, which is anywhere from 3 to 5 and 6% over the last 50 years, then I'm getting that for nothing. And usually stocks sell at a higher multiple than bonds because they have that growth component. Well, today, stocks are actually yielding more than bonds, and you still have that growth component. Admittedly, over the next 3 to 5 years, you may have a much slower growth than we did in the past, but you're still going to have some growth, and anything you have now over bonds is basically gravy. So the point I'm making is that whenever your earnings yield is equal to bonds, and certainly if it's more than bonds, then stocks are good value because you've got that growth potential. You don't have the growth potential on a bond.
And so would you say it's fair to take that earnings yield of 7% and add it to a growth rate, even if you want to be conservative on your growth rate and talk in terms of 3 to 5% growth?
Yes.
You add that to your earnings yield, and that gives you an idea of a future return?
That's right. If you took your 7% earning yield, especially if it was free cash flow, and we, by the way, we spend more time talking about free cash flow, which is the real earnings in a company, but let's just use the PE. If the PE was free cash flow, which in our companies it is, then you could add the growth rate, whatever that may be. Historically, it's been 5%, so that's why stocks have done better than bonds, because you got the earnings yield and you got the growth rate, and that can be anywhere from 10 to 12%. Now, if we take the current environment, which may not be as high a growth as it's been in the past, but over the long run, it'll regress back to the mean, I would say after 3 to 5 years in a slow growth period, we could have some much higher growth rate because of many exciting things that are coming on. But the bottom line of it is, to answer your question, yes, you can take the earnings yield and you can add whatever growth rate you expect, whether it's 3%, 5%, or 2%, and that would be your projected return.